What if I told you the most powerful force in the global economy isn't a president, a central bank, or even Wall Street, but an asset manager you never voted for? While politicians argue on television, firms like BlackRock quietly manage over $10 trillion, vote on corporate decisions across thousands of companies, influence ESG policy, shape housing markets, and even advise the Federal Reserve during financial crises. At the center of it all is Larry Fink, a man most people have never heard of, yet whose firm sits at the intersection of your 401k, your mortgage, your rent, and your employer. This isn't a conspiracy theory. It's the structural reality of modern finance. In today's episode of Economic Mechanics, we break down how passive investing, ESG, and institutional capital quietly reshaped capitalism itself, and why understanding this system is no longer optional in March 2023. When Silicon Valley Bank imploded, panic spread through the financial system at digital speed. Depositors ran. Venture capitalists warned of contagion. Regulators held emergency meetings through the weekend. And somewhere in those conversations, one private executive mattered more than most elected officials. His name is Larry Fink, CEO of BlackRock. Now here is the uncomfortable question. How does the head of an asset management firm become systemically relevant during a banking crisis? The answer is not conspiracy. It's architecture. BlackRock manages over $10 trillion in assets. That figure alone sounds dramatic, but size is not the real source of influence. There are large sovereign wealth funds. There are giant pension systems. There are governments with bigger balance sheets. The difference is connectivity. BlackRock doesn't just manage money. It sits at the intersection of global capital flows through its investment products, advisory roles, and risk infrastructure. It touches banks, corporations, pension funds, insurers, ETFs, and even central banks. When markets destabilize, officials need to understand where risk is concentrated, who is exposed, which balance sheets are fragile, what domino falls next. The institution that can map that web fastest becomes indispensable. That's where BlackRock's internal risk platform Aladdin enters the story. Used by financial institutions worldwide to model portfolio risk, it provides exposure analysis across thousands of securities in real time. When crisis hits, having visibility into cross-market risk isn't optional, it's survival. This is why during the 2008 financial crisis, the US government turned to BlackRock for asset valuation support. And in 2020, when pandemic-driven panic froze credit markets, the Federal Reserve hired BlackRock to help implement corporate bond purchase programs. This is not because BlackRock runs the government. It's because modern finance outsourced complexity to private infrastructure. Here's the structural shift most people miss. In the 20th century, financial power centered around banks. In the 21st century, it centers around asset managers. Banks create credit. Asset managers allocate capital. And capital allocation determines which industries expand, which companies survive, which technologies scale, and which business models dominate. When trillions flow through passive index funds and ETFs, the firms managing those vehicles don't just earn fees. They accumulate voting power across corporate America. BlackRock is one of the largest shareholders in thousands of public companies. Not majority owner, not direct controller, but consistently present. This creates a form of influence that is subtle, systemic, and largely invisible to the average investor whose retirement account funds it. And that's the twist. Most of BlackRock's power is exercised using money that isn't its own. It manages capital on behalf of pension funds, retirement accounts, institutions, and governments. Yet when shareholder votes occur, BlackRock often casts the ballots tied to those shares. Ownership is dispersed. Control is centralized. That dynamic minority stakes, combined with universal presence, creates structural leverage without headline-grabbing domination. So no, Larry Fink is not a secret ruler, but he operates within a system where financial intermediation has concentrated decision-making influence into a handful of asset managers. And when crises erupt, those managers become essential nodes in stabilizing the network. The deeper question isn't whether BlackRock is powerful, it's how that power was built. Because influence at this scale doesn't emerge from ambition alone, it emerges from a failure, a $100 million mistake. And that mistake built the machine. Next we examine how one catastrophic trading loss gave birth to the infrastructure that now underpins global finance. Before he was the face of modern asset management, Larry Fink was a rising bond trader at First Boston in the 1980s. He specialized in mortgage-backed securities, financial instruments that bundled thousands of home loans into tradable bonds. At the time, this was innovation. Mortgages became liquid. Risk could be distributed. Capital flowed more efficiently into housing markets. Then in 1986, one interest rate call went wrong. The desk lost $100 million. Not because the models were absent, but because the complexity had outgrown visibility. Mortgage-backed securities contained layers of embedded risk, prepayment assumptions, duration shifts, convexity effects. Small rate movements produced non-linear outcomes. Exposure accumulated quietly. Fink later described the experience as transformational. The loss revealed something larger than a trading error. It revealed that financial markets were becoming too complex for traditional oversight. So he left. In 1988, backed by Blackstone, Fink founded what would become BlackRock. The mission was not bold ambition. It was disciplined control. Build a system that could measure risk across thousands of securities in real time. That system became Aladdin Asset, Liability, Debt, and Derivative Investment Network. Here's why that mattered. Finance had evolved from simple balance sheets to interconnected portfolios spanning asset classes, geographies, derivatives, and structured products. Risk no longer sat in isolated silos. It was systemic. Aladdin allowed institutions to stress-test portfolios under multiple scenarios: interest rate shocks, credit spreads widening, equity drawdowns, currency dislocations. In effect, BlackRock built a financial radar system, and then they made a decision that changed everything. They licensed it. Banks, insurers, pension funds, sovereign wealth funds, many adopted Aladdin to manage their own portfolios. This created something unusual in capitalism: a private firm operating the analytical backbone of competitors, not controlling their trades, not dictating positions, but modeling their exposure. This wasn't a legal insight. It was structural visibility. When the 2008 crisis hit and Lehman Brothers failed, governments faced a terrifying problem. No one knew the true value of the toxic assets on balance sheets. Complex securities had frozen markets. Pricing mechanisms collapsed. The US Treasury and regulators needed valuation capacity immediately. They turned to BlackRock. Why? Because BlackRock didn't just own assets. It understood how they behaved under stress. Again in 2020, during pandemic-driven credit market panic, the Federal Reserve hired BlackRock to help execute corporate bond purchasing programs. When public institutions lack specialized infrastructure, they outsource to the private sector. That outsourcing creates dependency, and dependency creates influence. Here's the structural shift. BlackRock positioned itself not just as an investor, but as a risk engineer. In modern finance, risk management is not defensive, it is strategic. The firm that defines how risk is measured shapes how capital is allocated. If your model penalizes carbon intensity, capital shifts. If your stress tests highlight liquidity, fragility, portfolios reposition. Measurement frameworks quietly guide trillions, and the more institutions rely on the same analytical system, the more synchronized their reactions become during stress. That synchronization stabilizes markets. It also centralizes influence. By solving the problem of complexity, BlackRock embedded itself into the operating system of global finance. But infrastructure alone does not create dominance. Scale does. And scale arrived through something marketed as harmless, even boring: passive investing. Next, we examine how index funds turned diversification into voting power and how quiet ownership reshaped corporate control. For decades, Wall Street sold a simple promise: you can beat the market. Most didn't. Study after study showed that active fund managers underperformed broad indexes after fees. So investors did something radical. They stopped trying. Money poured into passive index funds, vehicles designed not to outperform the market, but to replicate it at low cost. And no firm capitalized on that shift more effectively than BlackRock. Through its ETF division, iShares, BlackRock became one of the largest providers of index funds in the world. Alongside Vanguard and State Street, it formed what analysts often call the Big Three. Now here's where things get structurally interesting. When you buy an S&P 500 index fund, you don't directly own shares of Apple or Exxon. The fund owns them. You own shares of the fund, and the fund manager votes the underlying shares. Individually, that sounds harmless. Collectively, it becomes transformative. Because passive funds must hold companies according to index weight, the largest firms receive the largest allocations. As assets under management grow, those allocations scale automatically. This creates universal ownership. The Big Three often rank among the top shareholders in nearly every major public corporation in the United States. They don't own 51%. They don't need to. Consistent 5 to 10% stakes across thousands of firms translate into durable voting influence. Now consider the implications. If the same three asset managers hold significant stakes in competing airlines, banks, energy firms, and pharmaceutical companies, their economic interest is not in one company defeating another. It is in industry-wide stability and long-term margin preservation. Economists refer to this as common ownership. The debate is ongoing, but some research suggests that when ownership overlaps across competitors, aggressive price competition may soften, not through illegal collusion, but through aligned incentives at the shareholder level. Think about it structurally. If shareholders benefit from all major firms in an industry, destructive price wars harm portfolio-wide returns, so management teams focus on discipline, rational pricing, shareholder value optimization. Competition remains, but the intensity can shift. And here's the subtle irony. Passive investing was marketed as decentralization, democratization, broad access to market returns. Instead, it concentrated corporate voting power into a few asset managers. This is not malice, it's mathematics. When trillions flow into funds that must buy everything in proportion to size, the fund providers inevitably become universal shareholders. And because passive funds cannot easily sell poorly performing companies without deviating from the index, influence shifts from exit to voice. If you can't sell, you vote. Which brings us to governance. As assets scale, asset managers develop proxy voting guidelines, policies that determine how they vote on board appointments, executive compensation, mergers, climate disclosure, and governance reforms. Those guidelines apply across thousands of companies simultaneously. This is efficiency at scale. It is also centralized influence at scale. The question isn't whether passive investing benefits investors. Lower fees have undeniably improved long-term returns for millions. The question is what happens when the structure of ownership changes faster than regulation adapts. Because once capital becomes permanent and universal, the levers of influence shift. And that shift becomes even more pronounced when voting frameworks incorporate environmental and social metrics. Next, we examine how ESG transformed passive ownership into active steering, and why capital allocation is now a policy instrument. In 2018, Larry Fink began using his annual CEO letters to push a concept that sounded philosophical but carried financial weight: stakeholder capitalism. Companies, he argued, must serve not only shareholders, but employees, communities, and the environment. Critics heard politics, supporters heard long-term risk management. But the real shift wasn't rhetorical, it was structural. Because when the CEO of BlackRock, overseeing trillions in capital, signals that environmental, social, and governance metrics will influence investment decisions, markets respond. This is where ESG moves from theory to force. ESG, environmental, social, governance, is not law. It is not legislation passed by Congress. It is not a regulatory mandate. It is a capital filter. If large asset managers integrate ESG scoring into portfolio construction, companies seeking capital must adapt to remain investable. And here's the mechanism: public companies depend on steady institutional demand for their shares and bonds. If major asset managers reduce exposure to firms with poor climate disclosure, weak board diversity, or governance concerns, the cost of capital rises for those firms. Higher capital costs reduce competitiveness. Lower valuations affect executive compensation. Shareholder votes become signals, so boards adjust. Disclosure increases. Carbon targets are announced. Governance committees expand. This is not coercion in the legal sense. It is incentive design. Now, from a pure financial perspective, the argument is straightforward. Climate transition risk affects long-term asset pricing. Governance failures destroy shareholder value. Regulatory shifts alter profitability projections. Integrating ESG can be framed as prudent risk assessment. But here's the tension. When three asset managers, BlackRock, Vanguard, and State Street, collectively hold significant voting power across corporate America, ESG becomes more than portfolio screening. It becomes directional steering. And because these firms often publish centralized proxy voting guidelines, decisions scale instantly across thousands of companies. That creates something new, and traditionally, capital allocation reflected decentralized investor preferences. Millions of individual investors, each making independent judgments. Now, trillions are pooled in index funds, where voting authority is exercised centrally. Even when asset managers offer pass-through voting options, the majority of retail investors remain disengaged. Convenience replaces oversight. Efficiency replaces fragmentation. This is not necessarily sinister, but it is powerful. Consider energy markets. If large asset managers publicly commit to reducing exposure to thermal coal or increasing allocation toward renewables, capital flows adjust. Energy firms respond by pivoting strategy. Investors interpret signals. Valuations shift. And all of this occurs without a single vote in Congress. Capital moves faster than policy. That's the core dynamic. The debate around ESG often devolves into ideological shouting, woke capitalism versus responsible investing. But from an economic mechanics perspective, the issue is simpler. When asset management becomes concentrated, investment frameworks become macroeconomic levers. And once capital becomes a steering mechanism, private governance begins to overlap with public policy, which raises a difficult question. If risk measurement built the infrastructure, and passive investing built the scale, and ESG built the steering mechanism, what happens when that same capital concentration enters the most personal market of all, housing? Next, we examine how institutional capital reshaped home ownership and whether the shift from owning to renting is structural, evolution, or wealth extraction. Home ownership used to be the anchor of middle-class wealth. You worked, you saved, you bought a house, you built equity. Simple. Then 2008 happened, when housing prices collapsed after the subprime crisis and the failure of Lehman Brothers. Millions of homes entered foreclosure. Prices fell 30 to 50% in some regions. Credit tightened. Individual buyers disappeared. Institutional capital did not. Private equity firms, hedge funds, and asset managers began purchasing single-family homes at scale. Among the largest players was Blackstone, which launched what would become Invitation Homes, building one of the largest single-family rental platforms in America. Now, here's where the structural link emerges. While BlackRock itself did not directly buy entire neighborhoods, it often holds significant stakes in the public companies and financial vehicles participating in this transformation. This is how modern finance works. Asset managers don't need to operate the business. They allocate capital to the entities that do. After 2008, large-scale landlords discovered something powerful. Single-family rentals produce stable, inflation-linked cash flow. Tenants pay monthly. Maintenance is centralized. Vacancy risk is diversified across regions. And institutions can finance purchases more cheaply than individuals. Fast forward to the 2022 period. Pandemic, stimulus, ultra-low interest rates, and limited housing supply collided. Home prices surged. Institutional buyers, often making all-cash offers, became increasingly visible in competitive markets. In some metro areas, they accounted for over 20% of transactions. Does this mean institutional ownership caused the housing crisis? No. Supply constraints, zoning restrictions, demographic demand, and interest rate policy play larger roles. But institutional capital changes market structure. When homes become financial assets optimized for yield, ownership patterns shift. And that shift aligns with a broader economic trend: access over ownership, streaming over DVDs, ride-sharing over car ownership, subscription software over boxed products. Housing followed the same logic. Build-to-rent communities now emerge, where entire neighborhoods are designed not for sale, but for lease. From a capital perspective, this is efficient. From a household perspective, it alters wealth formation. Home ownership historically functioned as forced savings. Rent does not. Equity appreciation compounds. Rent payments do not. So when ownership consolidates and renting expands, wealth accumulation dynamics change. This does not require conspiracy. It requires incentives. Institutional capital seeks stable, scalable returns. Housing provides them. Asset managers allocate toward predictable cash flow streams. Rental platforms qualify. Investors demand yield in a low-growth world. Real estate delivers. The result is structural. Ownership becomes concentrated. Access becomes normalized. Cash flow replaces equity building. Now step back. risk infrastructure, passive scale, voting power, ESG steering, institutional housing exposure. Individually, each development can be justified economically. Collectively, they describe a transformation. Capital management has centralized. Ownership is diffused among investors, but consolidated in control. Markets remain capitalist, but the nodes of influence have narrowed. This is not about one individual. Even though Larry Fink symbolizes the shift, the structure would persist beyond any single executive. The system now runs on asset aggregation. And here's the final question for you. If your retirement account is invested in index funds, if your landlord is backed by institutional capital, if your employer's strategy is influenced by concentrated shareholders, are you outside the system or fully embedded within it? This is the architecture of modern finance. Not secret, not hidden, but rarely examined. And once you see the structure, you cannot unsee it. Welcome to Economic Mechanics.